Hey everybody, I hope you are doing well. I am coming today to do a long anticipated video about Roth IRAs. So I'm going to try to cover what is a Roth IRA, why would you want to use one no matter how old you are and what stage in life you are at, parents, grandparents, why you might want to consider a Roth IRA instead of a 529 college savings plan, a custodial account, a joint account, and maybe some specific situations and when I use Roth IRAs for clients. So first, what is a Roth IRA? A Roth IRA is IRA being individual retirement account, or some people call it individual retirement agreement. You'll know it as an account. It's a bucket that you can put money into and then take that money and buy investments with. The IRS carves out the Roth because it allows you to put money in after tax. So this is after you've paid income taxes on the money that you've earned. Grows tax-free, potentially tax-free. And then you can take the money out in retirement, which the IRS defines as over the age of 59 and a half. You can take the money out and the earnings out tax-free. Now, you can get to the money beforehand, and this is, sometimes I don't tell my younger investors this, particularly if you're parents setting up a Roth for a child, you may not want to tell them, but shh, if you're younger and you're learning this, just don't tell anybody you know it. You can get up to $10,000 out of a Roth IRA, tax and penalty free, if you're paying for a higher education, or you're taking that money out to purchase your first home. So first time home purchase and higher education expenses. Now, there are some other nuances to the Roth IRA. This video is not intended to be a full and complete list of everything. I'm just going to tell you the highlights. If you have any specific questions, you can always contact us and we'll fill in the gaps. So, when should you do a Roth IRA? Well, the short answer to that is today, yesterday, last year. You should have already started a Roth IRA. If you haven't, don't worry, it's not too late. You can always start a Roth IRA. And I was on the phone yesterday with a client that is 64, I believe he is. He has this itty bitty Roth IRA that he started years ago. I don't know how he ended up with any money in it. So there's like $1,100 in it. But over the next 2 years, he will have tens of thousands and hopefully hundreds of thousands of dollars in his Roth. And I'll go through in a little bit how that is or how he's able to get that in there. Now, there are some limits. You can only put $6,000 into a Roth IRA if you're under the age of 50. And the reason is because the IRS and Congress age discriminates against anyone who's under 50. They do that in the 401k world. They do it in the traditional IRA world. They do it in the Roth IRA world. It is age discrimination. There is no other way to describe it. If you're under the age of 50, you can only do $6,000 a year. That works out to be $500 a month. If you're over 50, you're not discriminated against anymore. You can do an extra $1,000 a year, so you can do $7,000. That's same goes for the traditional IRA, and the 401k limits are considerably higher over the age of 50. So $6,000 a year for most people. That is for contributions. So that's new money going into the Roth IRA. I'm going to talk about conversions in a little bit, and that's different. So a contribution, $6,000 a year. My recommendation for the clients that we have that can afford to, you should be making those contributions January 1st or the first week in January every year for the entire amount. Just get the money in there and then move on. So you can put in $6,000 a year. It grows tax deferred, potentially tax free if you follow all the rules, and then that money comes out tax free. If you are a parent or grandparent, and you're thinking about saving money for or on behalf of your child or grandchild, the most common method right now is a 529 college savings plan, and that is a great plan. I have a 529 college savings plan for my children. But what I started doing when my oldest turned 7, and we do this with every child as they turn 7 years old, at 7, I believe that I can defend to anyone who asks that my child does in fact do work in which I pay them for, and through their earning of that money, we make Roth IRA contributions, or technically they make Roth IRA contributions. So, at 7 years old, they can, do things around the house. Before I had my own business, I 1099 them. In essence, they were an independent contractor. And, for us, they did work around the house in which we paid them for that work. So that's the important thing. If you are going to contribute to a Roth, you have to have earned income, which means you have to work. It can't be passive income. It can't be a gift. It has to be earned income. You have to have a job. So if you own your own business, you can put them on the payroll for doing whatever. I have a dentist friend. He put his kids on the payroll considerably younger than age 7. And what they did is they made those little bags that you get when you go to the dentist, where it's got floss in it and the toothbrush and the little thing of toothpaste. They would stuff the bags and make those bags, and then they got paid on a per bag basis, and then they made their Roth IRA contributions with that income. So you have to have earned income. So if you're a parent or a grandparent and you've got money maybe in a joint account or an individual account that's kind of earmarked for the kid, and you're like, I don't know really what to do with this money. If it's for a first-time home purchase, remember you can get $10,000 out, and you can always get the principal or the contributions that you've made to the Roth. You can always get that money out as long as the Roth has been open for 5 years. So at the beginning of this video, I said, when should you open a Roth? And I said yesterday, last year. Well, it's because you want to start that 5-year clock as soon as possible. It's not 5 years from the time the contribution went in. It's 5 years from the time the first contribution went in. So if you got $1,000 that you can plunk into a Roth IRA today, do that, get it into the Roth, and that starts the 5-year clock. Once it's open for 5 years, you can get your contributions back. I would advise against that, but you can. And you can get up to $10,000 of earnings for that first-time home purchase, or for for college educational expenses. So if you're a parent or grandparent and you're making and you're thinking about giving them money, and you don't really want to put it in a college savings plan because you want to give that money to them maybe after they graduate high school or after they graduate college, a Roth IRA is a wonderful tool for you to use if they end up not needing the money, if they end up being just very economically successful early on, then that money stays in there and it grows tax-free. So, but remember, they have to be earning income in order for you in order for them to be making contributions. So, what we do with our children, and here's what I believe is a far greater value add than just an account that grows tax-free, is I sit down with our children every year on their birthday or around their birthday, and that's when I make the contributions to their Roth, and we review their Roth IRA every year. And this starts at age 7, so on their 8th birthday, 9th birthday, etc. We're looking at their Roth IRA. Now, my daughter, who's 13, this year is 2021. If you know what the market's done for the last 5, 6, 7 years, she's never lost money. And it's been quite a frustration of mine, because my goal with their Roth IRAs was that they get to see their account balance move through time so that they understand that owning, and they own stock, they own a stock mutual fund. And my goal was that they would lose money from time to time so that they could emotionally understand that stock prices don't just go straight up. And for 5 years in a row, my daughter has just made more money, and she's done very, very well. And most of those years it was a double-digit return, which isn't normal, or at least I don't want her to think that it's normal. So fortunately, last year, during the COVID year, her birthday is in March. You know what happened. I mean, the stock market was just cratering in March. And finally, I was able to sit down with her and show her that her account value had gone down. And so that was good. She was still way up from what she had originally contributed, but it was nice to finally have her account value decline. When you teach your children or your grandchildren, one, don't look at your account annually, or any more often than annually, or maybe semi-annually, but don't obsess over it. Don't look at it all the time. Now, we talk about it, and they say, hey, how's the stock market doing? And I'm like, it's up or it's down. And they're like, oh, so my account's up or it's down. And we do that throughout the year, but they're not looking specifically at their individual account except for annually. And I think at that age, or really any age under 40, annually is probably enough to be looking kind of at the nitty-gritty details of your portfolio. So what happens over time as I'm educating my children, and as they get older, they ask more detailed questions like, okay, what is this 5-letter symbol that I own, this mutual fund? And then we'll get into the mutual fund, and they'll see the individual companies, and then the conversations are even more fun because they're like, oh, Walmart, I mean, that's in my portfolio, or Apple, that's in my portfolio. And my daughter's got an Apple Watch now, and so she's like, part of the profit from this Apple Watch that we bought is gone into the company, which comes back to me as an owner of the company. And I'm like, yes, you're getting it, right? And this is how these things work. And so my goal and my wife's goal is that our children will be financially literate for when they're out on their own. And then someday they're going to inherit assets from us, probably from their grandparents. And so if they're able to handle a $10,000 account and not freak out when it declines, 15 or 20% during a recession, or they're able to handle a $100,000 account, the principles are the same when they inherit a large sum of money, or when they get a large sum of money on their own. And it's just my experience as a financial advisor. I have seen the worst case scenarios when that beneficiary inherits a large sum of money. When they don't know how to handle a small sum of money, they certainly don't know how to handle a large sum of money, and that's when bad decisions are made. And so that's where I believe the real value of a Roth IRA when you're starting it for your child or your grandchild is that opportunity that they have skin in the game. It's their money, they're saving for their retirement, and we're able to have a very personal discussion about what's happening. So that's my case for starting your children or grandchildren with a Roth. Now, let's say that you are, let's say you're 60, and Roths didn't even exist until you were well over halfway through your working career, and you were doing the traditional 401k and maybe the traditional IRA and deferring taxes like you were supposed to, like everyone told you should, because of course your income in retirement, your income tax rate in retirement is going to be lower than it is in your working years. At least that was the theory. The current Biden proposal of tax rates, if you have been economically successful and you've done all those savings, at least in my client's experience, more often than not, you're not finding yourself in a lower tax bracket. the Trump tax cuts of 17 increased the standard deduction. So a lot of people aren't doing itemized deductions anymore. So, and then even that, you probably have already paid off your house, so you're not itemizing that deduction. You don't have children at home, so you don't have the child deduction. Maybe you deferred your Social Security, so your Social Security is going to be high. If both spouses were working, you've got 2 high Social Securities. Couple I was talking with yesterday, they both have pensions and they both have Social Securities, and they have these enormous traditional IRA buckets. Each of them have very large traditional IRAs. And so then they're going to find themselves at age 72 when they have to start taking required minimum distributions. You start stacking all this income up, and they're going to find themselves literally in the highest tax bracket they've ever been in their entire lives. And more often than not, I'm seeing that. So here's what we do. So let's say, and just follow with me here. Let's say you retire at age 65. So both spouses retire at 65 if they were both working. So we're not earning any money anymore, but we're deferring Social Security for at least one of the spouses. Typically the one with the higher Social Security amount will defer that if we can until 70. But if we can get a year or 2 or 3 or 4, ideally 5 or 6 years where there's no income coming in from working, there's no Social Security coming in, there's no pensions coming in, what happens is your taxable income is zero. It's zero. And so we get total control over how much taxable income you're going to incur. Now you can only do this if you have money to live on. So going into retirement, if you're 5 years out from retirement or 10 years out from retirement, you want to make sure that you're getting money outside of your retirement accounts in a joint account or an individual account or a trust account that you can live on for these 1, 2, 3, 4, 5 years when you're not taking Social Security and you're not earning any income. So what we do is we take that traditional IRA, and so it's July now. I'm going to start having these discussions in the September, October timeframe. And what we do is we call the CPAs or your tax preparer and we say, hey, right, this is where they're at. They have a mortgage or they don't, or they have a pension or they don't, or whatever. We do a dry run of their taxes later in the year, because by October or certainly November, you really know what your tax situation looks like for the year for the most part. You're not going to get any unexpected income that late in the year. So if you have zero taxable income and you're married filing joint, in today's world, we can get $50,000, $60,000 out of your traditional IRA and convert. I told you I'd talk about conversions later. It's later. Convert from the traditional into the Roth IRA. When you move that money, it becomes taxable income. That doesn't mean you're going to pay taxes on it though. So with working with your tax preparer, we're going to figure out how much we can move over at a reasonable tax rate. And when I say reasonable, if you're that couple I talked about earlier, we're at 72, they're going to be in the highest tax bracket ever. We're converting all the way through the 26% tax bracket this year, because they're going to be in that tax bracket for the rest of their life or higher. And so what we're wanting to do is we're wanting to get as much money out of that traditional, which every dollar you take out of the traditional is taxable, and we're moving it to the Roth. Once it's in the Roth, you're not required to take distributions. And when you do take distributions, it's not taxable and it doesn't add to your taxable income. So in those years, 1, 2, 3, 4, 5 years, we're making those conversions at a tax rate that we decide. So we get to decide how much we convert. So if you have a $500,000, $1 million traditional IRA, we could maybe move $50,000, $60,000, $70,000 a year, depending on the situation of the client, at a lower tax rate, lower than they'll ever be the rest of their life, If they have economically successful children, it's lower than they will be. And with the Secure Act that was passed in January of 2020, those children or grandchildren, whoever that IRA gets left to, they're required to take that money out in 10 years. So like in my personal situation, my tax rate is considerably higher than my mom's. So if she converts and she can convert over at the 20 or 26 or whatever tax bracket, that is a much lower tax bracket than I would pay if she were to pass away and then I inherit the money, because then I've got to take that money out in 10 years and I'm going to be paying a much higher tax rate on it. So take consideration of your tax rate once you turn 70 and then 72, but then also take into consideration the tax rate of whoever the beneficiary of the account is. And so in 2021 here, my advice to clients is convert until it hurts, and then convert a little bit more, because next year the tax rates are probably not going to be as attractive as they are this year. So that's where we're using Roth conversions. So start a Roth IRA as soon as possible. By the way, secret sauce, and this probably should be the title of the whole video: how to retire a multimillionaire without ever using an employer's retirement plan. If you are 18 years old or even 22, let's say you just graduated college, and you max out a Roth IRA, that's all you do. Put your $500 a month into a Roth IRA and do that forever until you retire. That is, for most people, more money in retirement than they ever actually needed. And this is just due to the compounding effect over time. Certainly if you're 14 years old and you're working part-time in the summer, you're working full-time in the summer, part-time in the winter during school, getting those contributions in. And I'll tell you a secret if you're younger, and this is a deal my mom made with me. If you make the money and you save, so back when I was younger, it was I think $4,000 a year is all you could contribute. My mom's deal was, if you make the money and you save that $4,000 in a savings account, she'll give me another $4,000 to make a Roth IRA contribution. So I've got the $4,000 over here that I can use to buy a truck or buy a house or whatever, but it had to be in savings. And then I got a $4,000 contribution to my Roth. So I had long-term savings, short-term savings, and it also taught me to take part of my income and set it aside. So certainly a lot longer video than I normally do. I appreciate you sticking with me through. And if you have any specific questions about your situation on Roths, I'm happy to discuss them. And other than that, have a great day. See ya. Hey, thanks for making it to this part of the video. If you have, please like and subscribe so we can reach more people. If you have a topic you'd like for me to cover, please call us at 928-421-0002 or email me at derrick@rileywm.com. Thanks again, and we'll see you next time.